Hello friends, welcome to this investment banking tutorial from Wall Street Mojo.
Let's move forward and look at the heart and soul of investment banking, that is the M&A activities. So every investment banking analyst may want to actually get into the M&A part because it is kind of very exciting and involves a lot of money here. So investment banks do a lot of M&A advisory roles. So let us now look at another important function of an investment bank, that is M&A advisory roles, and why it is very hot and why people would like to kind of join M&A advisory. You'll get all the answers here. So what exactly is M&A advisory? So firms who are interested in a merger or acquisitions, they look at potential targets, or they could be sellers in the market. They may want to sell their company, and they can probably look at selling their company directly to the buyer. But this is not something which is a liquid trade where there are ready buyers or ready sellers. So it is kind of very important to kind of look at every aspect of the acquisition, and the companies per se may not be equipped enough to kind of do all set of procedural due diligence, etc. So there are investment banks who actually help companies achieve that. So as you may be aware, there could be two kinds of M&A deals. One, it would be a sell side M&A deal. This would mean that, let's say, my company is on sale and I want to sell this company at a reasonable price. So you may approach an investment bank expressing your concern that you may want to sell the company, and obviously the investment banks are made for doing these M&A deals. Likewise, there could be a buy side M&A deal. Now there would be certain set of clients who would be or companies who would be kind of interested in buying potential companies who would kind of add up not only in terms of revenue, but strategically they are complementing in certain businesses. So it makes obviously a good sense for the buyers to identify potential opportunities, and that's where they can help take help from the investment bank. So what exactly investment banks actually do? Investment banks primarily take care of many different things. One is that they look at analyzing targets financial information. So they're as experts in finance, they dig deep into the financials and see how they are fitting in strategically. Number two is they do a lot of financial modeling and do forecast and understand scenarios as to what is the amount of benefit a merger or acquisition may actually lead to. They also help in assessing the core operations. So they go to the company visit, they meet people, they try to understand and evaluate the kind of synergies that are kind of possible. And likewise, they actually help in understanding what is the total cost savings that may happen once these two companies may merge. And at the end of the day, they are essentially trying to identify the opportunities and areas of concern, and identifying risks and benefits with appropriate valuation numbers. So investment banks are adding a lot of value here. So they negotiate with the buyers, they negotiate with the sellers, and essentially do all these tasks listed on the slide. So with this, when investment banks actually pitch to their clients, they take a presentation with respect to their potential targets and acquirers, and suggest the clients about whether they should acquire a certain company or not. So this presentation is all about calling it as pitch book in industry parlance. As an analyst or associate, you may spend a majority of the time creating these pitch books. So let's see in detail what these pitch books are all about and how they can be created and are important from the point of view of investment banking. So let us now look at what exactly is a pitch book. Now think about your clients. Let's take a case where you are an investment banker, and you are helping your client to identify potential opportunities for buying those companies out. So basically you are representing a buy side acquisition team, and you're helping the buyer identify key opportunities in, let's say, emerging countries. So you potentially have looked at many companies as such. So what is a pitch book? A pitch book is nothing but a presentation, and it is made assuming that your clients really don't have any time whatsoever to look at detailed conversations. So at one snapshot, let's say in 2 minutes or 3 minutes, will you be able to give a heads up to your client that these are the potential targets to look at, this is the overall synergies, and this is how it could be placed. So in fact, majority of the investment bankers spend a lot of time in making these pitch books, because when they go to the clients, they need to have something prepared for as a topic of discussion. So think of this as the first step forward to the client, and if the client is showing any interest, then at later point in time you can talk about the details as such. So a sample pitch book could be something like this. So as we understood that the pitch book is a presentation, it contains the following. Basically, it overviews the executive summary and the high level details about the potential size. And this pitch book content is mainly towards the sell side M&A, where a company is trying to sell their own stake to some other company. And when we talk about the industry, think about giving market size, market share, competitiveness, essentially brief discussion, and a short company profile with appropriate valuations. So the most important thing where investment bankers actually talk about valuations is not the detailed approach of doing financial modeling like what the research analyst may do in the equity research department. The investment bankers, in fact, just make a quick comparable and precedent transactions as a first case of valuations. So all in all, these are the fine prints of pitch book, which is on the sell side. So just to give you more details, it may contain a lot of things, information about revenue split, different kinds of charts, etc. Some of the samples are like this. As you can see on this chart, there could be a share price detailing what has happened with the company, what has not happened with the company in detail, why the stock prices have been moving up or down. So these are the things that you may have to do. These are just the samples which I'm actually running through. This is something like comparable transaction, where you are trying to compare a certain set of companies and looking at what was the implied valuations at a reasonable price. So if you're not able to understand this, think about making all these once you have completed the valuations module altogether, because this comes as a part of your regular activity as an investment banker. So this is called as precedent transactions. So I'm just running through some of the slides where you may have to work on this as a part of your investment banking pitch book. So with this, we have learned M&A, and we have also looked at what is a pitch book.